And I'm a bit scared for the property market in general, because if the government is guaranteeing so many loans, they're not going to let the house market crash. And I feel like every time there's been an economic crisis or something going on in the economy, the government has stepped in and not let the house prices correct themselves, which just doesn't work longer term. Like it's like the stock market. You kind of need small corrections to bring it back to actually the intrinsic value. But I think now that the government is guaranteeing so many of these loans, they are less likely to step in and let it self-correct.
Welcome to the Get Rich Slow Club podcast. I'm Ana and I'm here with Tash. And we are going to talk about something that has been a little bit controversial. It is the 5% deposit on the first home scheme. Is it an opportunity? Is it a risk? We're going to dive into it.
So I love how they changed the name of this to make it more confusing as well. So now they're referring to it as the 5% deposit scheme, but it used to be called the First Home Buyers Grant. First Home Owners Grant.
Okay, so I wasn't crazy. Yeah. I was like, what?
I made a post on this for my Instagram and we were calling it the First Home Owners Grant. And then the 1st of October came and then I went back to double check the information to make sure I was correct. And I was like, what is going on? But they changed the name of it.
I honestly feel that all these schemes can have just better names.
Yes.
Like the First Home Super Saver scheme, this, that, like it is so confusing to even figure them out. And also as someone coming to Australia, scheme always sounds like scheme.
Yeah, like a scam.
Yeah.
I'm going to quickly run through them. I think that might be really helpful before we dive into the 5% one. So today's episode is focused on the 5%, but just an overview of them. We've got the First Home Super Saver schemes. This is when you put money into super and you withdraw it to buy your first home and you can save on tax. That's the benefit of that one. You've got the 5% scheme, which is what we're going to talk about today, where you can buy a home with a 5% deposit without paying LMI, lender's mortgage insurance. The government guarantees the next 15% for you. There's also a Help to Buy scheme coming soon, which is like a shared equity. They've had this in WA for a while. What would we call it in WA? Key Start or something? I can't remember what it was called, but it's been happening in WA for a while where the government owns like 30 to 40% of your property. So you pay a less mortgage and less everything, which is good, interesting though. And then there's also the First Homeowners Grant, but you can get between $10,000 to $30,000 depending on which state you are, which is just cash towards your first home if you meet criteria. So there are ones to save on lender's mortgage insurance, save on tax, and also just get cash.
Yeah, very confusing. Are you still with us?
Yes. So 5% deposit scheme.
Yeah. So this started in October 1st of this year.
It was started beforehand, but it's
true.
Yeah, they've updated it the 1st of October this year. So it used to be limited to a certain number of places and there used to be income limits and there was kind of really strict property price cap limits, but now they've expanded it.
Yeah. So back to what Tash said, you can purchase with a 5% deposit without having to pay lender's mortgage insurance, LMI.
Previously, without this scheme, you had to either have a parent guarantee the property for you if you bought with a 5 or 10% deposit, or you had to be in a certain occupation to get these loans, or you would just have to pay an extra lender's mortgage insurance fee, which could be like something like 10 grand extra.
Mm-hmm. So the government guarantees a portion, so up to 15% of the loan to the lender, which substitutes for what the LMI would essentially cover. So in another way, like this is taxpayers' money, right? If you think it over, technically, if the government's paying for it?
Yes.
This is some of the criticism that I saw online, but anyways, we'll get into some of the criticisms, but it's just interesting to kind of like note that as well.
Yeah.
So like you said, previously the scheme had caps on a number of places, income limits, and lower property price thresholds. This removes a lot of that. So there's no income cap anymore. So any first home buyer who meets the criteria can technically use it. There's no place cap, so it's more open rather than a limited amount of participants. So that's really great. More people can access it. There's a higher property price. So this was really interesting, like looking at the different numbers. Sydney's cap rise goes to 1.5 million. Melbourne is now 950,000. I was actually really surprised that it wasn't higher here in Melbourne, but that's probably because our prices have evened out a little bit here in Melbourne.
And also just because you can't actually borrow that much money anyway.
Yeah.
The biggest problem with it, which I'm sure we'll get into.
Yeah. So Brisbane is 1 million. Mm-hmm. Anyways, that's all I have listed here. So sorry for the rest of Australia. The scheme applies across major cities and regional areas under the same umbrella, and it applies to owner-occupied homes only. So this isn't an investment property. So you still need to pass the lender's credit and serviceability check. Oof, I always find that word so hard to say, serviceability. You still have to have at least 5% deposit plus other transaction costs. So you still need to cover stamp duty, the legal side of things as well. The guarantee protects the lender, not you. So if you default on the property sale, It doesn't cover the loan. The government still pays the shortfall up to the guaranteed portion.
Let's do pros and cons.
All right, cool.
Pros, you can use this scheme with the other ones. So if you can meet all the other criteria, you could use the first home super saver scheme to save the 5%. You could use this one. And then you could also get maybe a first homeowners grant if you qualified as well, which is pretty exciting. I think it's really good to kind of remove the inequity that exists when some people have parents who could guarantee their properties and others couldn't. So this is really fun that the government can actually step in and say, it doesn't matter if you've got parents with property or not, we will guarantee the 15% for you, because there was like kind of gap before where people who had parents to guarantee it, they were not having to pay lender's mortgage insurance, but those without would have to pay it. So that's really great. Mm-hmm. It's great that you don't need to save as much, but that obviously comes with cons as well.
Yeah. I mean, to that point, it's a faster entry to home ownership, right? Like that's the idea that you can get your first home faster.
The idea. But I think the problem these days is people don't have enough borrowing capacity.
Yeah.
It's not actually the deposit. It's like, yes, it's really hard to save a 20% deposit when houses are $1.5 million in Sydney. That is massive. But the real problem is being able to borrow that much money. Like it's crazy trying to optimize your income and actually be able to afford that much. And it's hard.
It's so expensive. Yeah. It's so expensive.
Cons though, it was predicted to raise house prices, and it seems to have. It's been the fastest month of house price increases in the last few years.
Would you have guessed that, Tash?
No, would you have seen this coming? I think almost my hot take on this is I think the media around it has made it worse than the actual scheme itself. There's been so much FOMO in the media saying you have to buy before October 1st. Otherwise, all these people are going to flood the market. But I feel like there wasn't actually that many people who were going to flood the market for the scheme itself. It really only properly benefited higher income earners who weren't eligible for the scheme already. And often those people would have parents who would have guaranteed their properties anyway. So I feel like there wasn't actually that many more people who were going to use it. I think there was just this big FOMO that was brought forward because I think they moved the scheme forward to October 1st. It was going to be like next year instead. So I think the media around it made everyone try and jump in and buy properties in those price ranges earlier, which has not helped at all. And there's also the risk of people buying properties with such low deposits too and having such massive mortgages.
Yeah, when you think it over, if you're only putting 5% down, you have a 95% of the loan, right? Like what if your property gets devalued in time and then all of a sudden you have to still pay that loan back, but your property is no longer that value. And that does happen. It doesn't get talked about a lot because there's a lot of speculation that happens in Australia. And we always think properties are going to rise all the time, but that's not always the case.
It happened in Perth in 2013, 2014. There was a slump in the mining sector or whatever it was. And a lot of construction workers went home because there wasn't enough work anymore. And there was a suburb called Baldivis that had the highest rates of bankruptcy for a little while. And it was mostly those people who had bought brand new homes or house and land packages and then had really small deposits. And as soon as the prices dropped and they couldn't sell their house for what it was worth, a lot of people went bankrupt.
Yeah, that's called negative equity,
10 years ago.
Like how sad is that to put all your money in? And let's say, it's not $500,000. Let's say that's $1 million. And all of a sudden, the $1 million property you bought is now worth $500,000.
Well, it doesn't even need to be that dramatic, I guess. Like it's
even $100K.
Yeah, in Melbourne, we've had like 5% drops in some suburbs. So if you have your 5% deposit and then your house drops maybe $100,000, and if you want to sell the property, you've then got to pay the selling costs and the stamp duty and all the other things to buy a new property, but then also make up that shortfall in your mortgage.
Yeah, huge. The other challenge with this specific scheme is that there's a really thin margin of error. So for example, if you lose your job or something happens, you can't financially cover the loan, that is a huge risk as well. It's not like you have a lot of equity in the house that you can kind of pull out or do anything with. You still have to pay that mortgage. You still have to pay that money.
Yeah. So my mortgage is what? $650,000, my one on my Brisbane property. And those repayments are over $900 a week.
Yeah.
So if you're trying to buy a property that's $1 million and you need to have a $950,000 mortgage, and then you're spending $1,500 a week or more, that is a crazy amount of money for a house that's pretty average these days.
Yeah. And we're not just talking about losing a job or having some kind of situation come into play. What if interest rates rise?
Yeah. Or council rates go up.
For sure. Yeah. That's a lot of money.
Insurance is going up.
Yeah.
And if you're right on the edge of only being able to afford it, that's terrifying.
It's really scary. In fact, sometimes I'll see online, people talking about this and being like, I bought this property at 5% and now I can't afford it because I'm going through a divorce or whatever it might be. That's a really scary and challenging time for people.
I have been watching The Big Short and reading The Big Short and reading other books from that era of finance.
It's a fun time, isn't it?
I was reading Liar's Poker as well. So that's about investment banking in the 1980s and 90s. All very fascinating. But Yeah, it's kind of interesting watching it now where we're not like that dramatic yet. Like we have way more policies and procedures in place and we're not getting that dramatic. But the problem with the US back in 2008 was that prices didn't even have to fall for people to go bankrupt. So they just had to stop growing in value. And I feel like we're kind of at that point a little bit now, like not exactly, but a lot of people are buying property to hope that they actually increase in value, not because they're making the money from the rent or anything like that. And if we're betting on property to continue to grow in value, to make our investments work and to make our financial life work, like that's a pretty scary bet to make.
Well, it's also hard because like the only person winning here really is the banks. Like the banks are really winning by like giving out bigger loans. Another risk that could potentially happen is that these loans might be seen as more riskier and therefore they could potentially be higher as well. At the end of the day, the bank's going to win out regardless of what happens. So you have to be really, really careful if you're going to be taking out a loan and you only have 5% down.
And I'm a bit scared for the property market in general, because if the government is guaranteeing so many loans, they're not going to let the house market crash. And I feel like we need the housing market to have a little bit of a reset and correction. Like I think during COVID, it was propped up so much when it should have actually crashed, not like crashed completely and had people go bankrupt everywhere, but just like corrected itself slightly. But we didn't let it correct itself. It just kept going. And I feel like every time there's been an economic crisis or something going on in the economy, the government has stepped in and not let the house prices correct themselves, which just doesn't work longer term. Like you have to, it's like the stock market, you kind of need small corrections to bring it back to the intrinsic value. But I think now that the government is guaranteeing so many of these loans, they are less likely to step in and let it self-correct.
It's interesting that you're reading about like the Big Short and all of that stuff, because what I'm really diving deep into is like policy and how policy really changes the trajectory of housing, of investments, and of investor sentiment. And similarly, it's like we have certain policies in place, like negative gearing, the 50% capital gains tax benefit, like all of these things are put into place in order to prop up the housing market, right? And if we continue to prop up the housing market, what's that going to do for first-time home buyers, people trying to get into the market? At the end of the day, the rich just get richer, right? And that divide gets really big. So this is what I'm diving into. And I see it, you see it every day in what's happening online, right? Because it's like these big tax breaks will benefit people who have property, whose house, like I own a house. I would love for it to go up in value when I'm planning on selling it. It doesn't matter right now day to day because I'm not selling it, but that really sucks for anyone getting into the housing market. I remember like my feeling was completely different when I was buying. I was like, oh my gosh, these boomers are coming in and outbidding me. And that's the challenging thing that we see, because it becomes less equitable because we have policies in place and we're doing things that might look like they're benefiting people getting into the market, but what really they're doing is propping up people who already own property.
Yes.
That was my rant.
Yes.
Sorry.
Back to an individual level, this stuff is very interesting, but should you use the 5% scheme if you're looking to buy a home? One of my regrets was actually putting down a 20% deposit when I didn't need to when I bought my first apartment. Because if we're just looking at it from like a spreadsheet mathematical answer, if I had only put down a 10% deposit and had my parents guarantee the other 10%, I could have invested that money instead. And I had a very low, like 2.6 interest rate back then. And I feel like that would have been the better mathematical answer, but I liked the idea of putting down 20%. So I think if you're looking at it from like if you have spare money and you can use the 5% and take advantage of it and then have more money in your offset, or then choose to invest or start a business or do other stuff with your money, maybe that's a great idea. But the part that concerns me is when people are borrowing their max amount that they can borrow and really stretching themselves really far with the 5% deposit, and they've got no wiggle room once they bought the property.
Yeah, because your situation was different. You had the 20%. So you're like, oh, I could have put the 5% in and used that money differently and I would have been fine because I have wiggle room.
So if you're in that situation, maybe you'll consider using it and benefiting it. But if you're really, really stretching yourself, it's a hard decision to make.
Like, let's say you only have 4% now, and then you finally got to 5%. You're like, I barely got here. Oh my gosh, I could buy a house.
Yeah. And then you buy it and then you're stretching yourself a bit more because like something else has happened and you need to bid 10 grand more. And then you buy the property and then you've got to pay your conveyancer fees. And then all of a sudden you get all your rates come through because it's August or whatever it happens to be.
And then interest rates have gone up and all of a sudden you had an injury and you have to take time off from work. Like that is a really hard place to be in.
Yeah.
Right?
Been saying that, we also acknowledge that the FOMO that goes on at the moment too, where there is a feeling that if you don't get in, and with house prices increasing so quickly, it might be unaffordable in 6 months' time. So it is a really hard spot to be in.
Because that's the challenge, right? Like wages haven't kept up with housing and that divide has gotten bigger and bigger. And a lot of that is due to speculation. So it's really hard when you're like, oh my gosh, like I just can't make more money. I can't bring in more money in order to buy property and otherwise I'll never have one. And what am I going to do? Like just rent forever? That's hard.
Yeah.
Yeah.
I think maybe we can like try and be more creative around it. I know that's really annoying to say, but can you buy with a partner? Can you buy with a sibling? Can you buy with a friend maybe and split the mortgage and the risk that way? Maybe there are different options of trying to get into the housing market. Are you going to buy it and rent out a few rooms instead?
There's a lot of ways to be creative. Yeah, for sure.
What's your verdict? Should someone use it? My verdict is yes, to jump in and interrupt you after I asked you the question. I think in this current market, you have to take use, or you have to take advantage of everything available to you. So I think if you're trying to get into the housing market, you should use the first time super saver scheme and save on tax. You should try and see if you're eligible for the first home buyers grant. Maybe you're not because you don't want to build new anymore. You should probably try and take advantage of something like that. Because if other people are, you kind of need the edge as well, but also make sure you're not putting yourself in a really, really, really stressful situation.
Yeah, I think my answer is it depends. Like anything in personal finance, it just depends. It depends on if you have an emergency fund. So how long will that take you? Like if interest rates go up or if something happens and you have to fix something in your house, how much wiggle room do you have is probably like the first question that I would have. Are you stretching yourself thin? I think it's worth like talking to a broker and running all the different numbers. And they're really helpful sometimes with this where it's like, okay, if I do 5%, is that beneficial? What if I do 6% or 7%? Or, how long will it take me to get there? How much can I borrow? Also just like run the numbers. Like just because you own property now doesn't mean it's going to be the same amount as your rent, right? Like rent, you always have a fixed cost. You know exactly how much it's going to cost you, but there's so many like surprise things that happen. Our neighbor had like a car run through the fence between our houses, right? Like that's an additional cost that you might not have expected. Like random things that might happen where you like least
my
expect
parents'
it.
roof falls in sometimes in the lounge room. They renovated years and years and years ago, and they like added like not really a second story. There was kind of a second story. Anyway, they like added this extension on to the top bit, and like whenever there's a massive storm, the roof caves in our lounge room.
Gosh, that's terrifying.
And you have to like obviously there's insurance, but you still have to sometimes pay for things up front, and then your insurance increases the next year.
Yeah,
just stuff like that where you're like not expecting a roof to cave in.
And when we don't know with climate change, like their insurances might go through the roof. No pun intended.
My levy for my council rates in Brisbane, there's like the environmental levies and the disaster levies that are randomly increasing as well.
Oh yeah, surprise.
Yeah.
But like these are just, there's so many question marks. With renting, what you're going to pay. And with housing, you do not. So you definitely want to have a bit of that buffer. And if that means like you're going to have to save for an additional year, maybe you want to do that. I don't know, right?
Can you buy in a different suburb? Mm-hmm. Can you buy a different type of property? I think there's also other ways to look at like what can you do if things go wrong? Like, is it a property where you've bought a 3-bedroom and you could rent 2 bedrooms out? Because with the housing crisis, you can get tenants pretty easily now to rent a room out too. Like that's always a consideration as well.
Are you buying an area that is you maybe don't want to live in long term, but you're doing it because it's your first home and you're going to live there for a bit and suck it up for a year, and then you might rent somewhere else, or you're going to try to pull out equity at some point, or who knows? There's a lot of question marks there. So I think I'm similar to you. It's like, yes, you could use it, but I would also just do all the math for our worst case scenario and like think like a really worst case scenario. Like not to be a downer, but that's just like what I did with our housing as well. Like we were like, we know I'm not going to be working full time for a while. We know we're expecting another child. Like there are just like certain things we don't want to spread ourselves too thin. We don't want to be like, we are now house poor. We have a house and we cannot do anything else, and we can't go away on the weekend, and we can't buy new clothes.
But maybe that's what you want if you have a family and you don't want to have to be at the mercy of landlords.
Yeah.
And moving all the time too. It's such a hard one because it's like not a great place to be at the moment. And I think the government's not done the best job either with it all. So it is like a terrible place to be where you're deciding between stretching yourself financially, which you might have to do, versus like being at the mercy of the rental market, which is also terrible at the moment too.
Yeah. Oh, I know. This is such a hard place to be in. I just wish like everyone had security. Like I'm such an idealist. I was like, I just want everyone to have a home and feel like secure, and that it's not like spreading you thing. And unfortunately, that's just like not life, unfortunately.
Yeah. Try not to let FOMO get to you too much, although I know it's really, really, really challenging at the moment.
You know what I do love though? I love online when people are sharing pictures of their old kitchens and their like scratched up floors and their older houses, because I think that the internet also makes us feel as though like everything has to be brand new and has to be a nice new house, and like you have to have the nicest furniture, and like that's just not life. Like I think of my family's generation and all our like couches that didn't match. Like I want to bring that back and be like, yes, this is like the new thing. So
bring back the share house vibes.
Yes, share house vibes are so fun. Yeah.
When you go to someone's house, they literally have the most random couches ever, but everyone's having fun.
For sure. So like back to that FOMO piece, it's, you are doing your own thing at your own time. Don't be looking at other people. We don't know whose parents are helping who, or what's happening in what kind of financial situation on their end. Just like look at yourself and just focus on your own risk level and your long-term goals. And
how do you optimize your situation?
For sure.
Do you put more in super? Do you use this scheme? Do you use that scheme? Do you invest in shares instead? Like you can still do things to help you move forward, even if it's not buying the dream house right this moment.
Exactly.
And hopefully it will calm down because this is crazy.
Yeah, I agree.
Thanks for joining us.
All right, bye.
Bye.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Ana Cristina.
The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Ana Cristina from Perla. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you. This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging.